Hi everyone, I'm here on behalf of our group, Fantastic 3 from IPMI International Business School. So in this video, we're going to share the key lessons from the book of Psychology of Money by Morgan Housel. This book isn't just about how to get rich. It's how about people think, feel, and make decisions about the money. Because in the end, the financial success isn't just about the intelligence, it is about the behavior. We will walk through each chapter in a simple and relatable way. So let's get started.
Have you ever looked at someone's money choices and thought, that's crazy, right? Buying lottery tickets, never investing, or spending a huge salary carelessly? So here's the truth. To them, it's not crazy. It makes sense based on their own life experience. Why? Because we all grew up with different backgrounds, cultures, level of income, experiences with the economy. For example, in real life situations, there are someone who grew up poor might fear losing money and avoid investing. Or for someone raised by wealthy parents may see the stock market as safe and normal. But for people who live through a crisis may save every penny even when it's not necessary anymore. So people don't make financial decisions with spreadsheet. No, they make them with emotions, memories, and survival instinct. You cannot fully understand someone's money behavior until you understand their story. Success in finance isn't just about hard work, it's about luck. And failure isn't always about mistakes, sometimes it's just risk. For example, Bill Gates became a tech icon partly because he happened to attend one of the only high schools in the world with a computer in 1968. That's luck. His friend, Ken Evans, was just as smart but died in an accident before reaching his potential. That's risk. Don't blindly copy successful people. You may be copying luck, not skill. And don't just fail too harshly. They may have done the right thing but go hit by bad luck. In investing, two people can make the same decision. One get rich and the other one is lose everything. Why? Timing random and market behavior outside their control. Lesson is, be humble. Your success is never 100% your own. And don't be too hard on yourself. Sometimes risks just show up.
How much money is enough? For some people, it's never enough. For example, Rajat Gupta was worth 100 million, but he wanted to be a billionaire. He took illegal shortcuts, got caught, and went to the prison. Bernie Madoff had a successful businessman, but created a Ponzi scheme to get richer and lose everything. So here's the lesson. Taking huge rich for money you don't need is dangerous. Chasing more without knowing your limit can destroy what you already have. In modern finance, many people overinvest, overleverage, and overspend just to keep it up with the others. But wealth is meaningless if it costs you a peace, health, and a reputation. So, the key to take away enough, it's the powerful word. It keeps you grounded and protects you from unnecessary financial risks.
So, what's the most powerful force in building wealth? Not luck, not intelligence, it's compounding, a small growth over time. So I will give you a real example from this book. So Warren Buffett built over $18 billion of his wealth after turning 50. No, not because he found a strict strategy, but because he started investing in age 10 and keep going for over 70 years. That's amazing, right? So, investing is not about finding the highest return once, it's about earning given returns consistently over a long time. Most people underestimate how big small gains can grow when given enough time. So, here's the math. When you are investing 1,000 with 10% annual return, in year one, maybe you will get like 1,100. You will get 100 in year 1, and then in year 2, maybe you will get like 1,200 something, and in year 10, you will get 2,500 something. But in year 30, you will get like 17,000 something. That's the magic of the compound growth. Okay, so start early, be patient, stay invested. You don't need to be genius, you just need time.
Getting rich and staying rich is a two different skills, and most people only focus on the first one. Getting wealthy takes a risk-taking, bold decision, and optimism. But staying wealthy takes humility, frugality, caution, a healthy dose of it. For example, Jesse Livermore made millions in the stock market, then lost it all more than once. Many people grow their wealth only to lose it by thinking it will never end. Wealth isn't just about growing money, it's about protecting it by avoiding big mistakes, living below your means, and preparing for the unexpected. Getting rich is sprint, staying rich is a marathon.
In investing and life, a few big wins often make all the difference. We call those tail events, rare outcomes that have outside impact. So for real life example, venture capital firms expect most of their investment to fail, but a view that success, like investing early in a Google or Facebook, pay for all the losses and more. Even the Warren Buffett made most his fortune from the few investments like Coca-Cola, Apple, and American Express. So the financial insight here, you don't have to be the right all the time. You just need to be right a few times and be patient enough to let those wins grow. So important mindset here, don't be panicked. If someone investment don't work out, that's a normal thing. Success often comes from just a few bets and work really well. So the key takeaways, that's your winner's run. Don't kill a great investment too early.
What's the highest form of wealth? It's not about money, it's freedom. The ability to do what you want, when you want, and with the people you want. Think about this. Would you take a job that pays double if it meant zero time for your family? Or would you trade peace of mind for luxury if you're always stressed? Most people want money because they think it will buy happiness. But what really brings happiness is control over your time. The insight is, having some saving or passive income gives you option, and having option gives you freedom, like saying no to a job you had or taking a break when you need. Here is the truth. Wealth is about looking rich. It's about living life on your own terms. The goal is just to be rich. It's to wake up and do whatever matters most every single day.
Have you ever seen someone driving a luxury car and thought, wow, that person must be very rich and successful? That's the paradox. But here's the truth. When someone drives a Ferrari or wear a designer brand, we don't admire them. We just imagine ourselves in their place. People think showing off wealth earn respect. But in reality, others really think about you. They only think about themselves. Trying to look rich often backfires you. People are impressed by humility and authenticity, not status symbol. Meanwhile, truly wealthy people often do not feel the need to prove anything. They don't need to prove anything. For example, a flashy car may attract attention, but it rarely earns admiration. Real respect comes from how you treat others, not what you wear or what you drive. So don't waste your money trying to impress people because they're not thinking about you as much as you think.
So when you see someone with a big house, fancy car, or designer clothes, what you're seeing is spending, not wealth. Real wealth is invisible. That's a money not spent. It's saving, investment, emergency funds, and the financial freedom behind the scenes. So the financial insight here, many people look rich, but are actually living a paycheck to paycheck, and then the others may look ordinary but have a million saved because they live below their means. So the important reminder in here, wealth is like an iceberg. 90% of hidden, it's a built quality through this discipline and patience. So for example, a person who drives a used car and avoid lifestyle inflation might retire early, while someone with the new car, this and luxury habits might never be free from debt. Don't confuse. Wealth is a status. What you don't see, the money someone didn't spend, it's what built true financial strength.
If there's one financial habit that works for everyone, it's saving money. Not just to buy things, but to give you option. Saving isn't just about what you're buying later. It's about freedom, flexibility, peace of mind, and the ability to say no when something doesn't feel right. You don't need a high income to start saving. You need discipline. Saving about your behavior, not your paycheck. People often say, I'll save when I make more. But if you don't save when you make a little, you probably won't save when you make a lot either. So, saving gives you control over your life. It helps you deal with emergencies, take risks, or retire early on your terms.
In personal finance, you don't need to be perfectly rational. You just need to be reasonable and stick to what actually works for you. But what's the difference? Rational is being the smartest thing to according to math and theory. But reasonable is doing the thing you can emotionally stick with for a long term. The best plan is not the perfect plan. It's the one you can live with. If a higher investment scares you and keep you at night, then it's not reasonable, even if the numbers say it's right. I will give you a real example from this book. Paying off a low-interest loan early may not be mathematically optimal, but it might give you a peace of mind, and that's worth a lot. Finance is not just numbers, it's emotion, habits, and life. A good financial plan is one you can stick with when life gets messy.
When it comes to the money, history feels like a guide, but the future is full of surprises. Most of what shapes the economy, markets, and personal wealth is unexpected. Pandemics, crashes, bombs, wars, tech breakthrough. The biggest events are often the things no one predicted. So, don't build up the entire financial plan assuming the past will repeat exactly. Instead, prepare for surprises. Make room for things you can see coming. Real-world example, in the year of 2000, no one expected 9/11. In 2007, very few saw the global financial crisis coming. In 2019, no one predicted COVID-19, but each of these changed the financial world forever. Accept the unexpected, build flexibility into your money decision because surprises are there normally.
The most powerful financial strategy isn't good. It's having room for error, a margin of safety. What does that mean? It means planning for the fact that things will not always go your way. Expecting everything to go perfectly is the fastest path to disaster. Keep extra savings, don't invest every dollar, assume your job, your health, or the market might hit a bump. For the example, an investor who expects 10% returns every year will panic during a crash. But investor who build a cushion, expect and the unexpected will survive and keep going. Success in finance is not about being right all the time. It's about staying in the game long enough to let your smart choice work.
Here's something we often forget.
when making a long-term financial plan. We change. What feels right today might not feel right 10 years from now. Your goals, values, lifestyle, and definition of success will evolve. But that's completely normal. Be flexible. Don't lock yourself into a plan that assumes you will always want the same things. For example, you might want to retire at 35 today, but at 35, you might love your work and want to keep going. Or you might prioritize status now but crave something simplicity later. So don't be afraid to adjust your financial goals. The goal is not to be perfectly consistent, it's to build a life that still fits you who you are as you grow.
Here's the truth. We don't hear enough. Everything in finance has a price. Even if not listed on a receipt, we often think of money decisions in simple terms. Buy low, sell high. Save more, spend less. But in the real world, those things are hard, not because they're complex, but because they're emotionally expensive. The hidden cost of wealth, volatility, stress, doubt, waiting something for years. People want the rewards of investing like higher return, but they don't want to emotional roller coaster that comes with it. So when the stock market crashes around 30%, many people panic and sell. They think something's wrong. But the volatility is the price admission to building long-term wealth. It's not signed to quit. It is cost you have to pay. Going to the college costs money, time, and effort. But we accepted that because we know the long-term value. Investing the same, you pay with the patience, fear, and uncertainty. And the reward comes later. Nothing is truly free. When things get uncomfortable in the finance, ask yourself, is this pain, a penalty, or just a price of something valuable? Often, it's the price and it's worth paying.
Have you ever asked, why would someone invest in that, or why would they sell so soon? They also might surprise you. They have different goals than you. In finance, two people can look at the exact same information and make opposite decisions, and both can be right for themselves. For example, a day trader might buy and sell stocks within hours, looking for quick profit. A long-term investor might buy that same stock and hold it for 20 years. They're using the same market, but for totally different purposes. Here's the mistake most people make. We assume other people are playing the same financial game as we are, but they're not. Someone saving for retirement in 30 years needs a different strategy than someone saving for a house next year. What seems risky to you might seem safe for them, and vice versa. So the lesson is, be careful when copying others. That influencer you're watching, their income, goals, risk, tolerance, and time horizon might be nothing like yours. And if you're judging someone else's choice with knowing their context, you're likely misunderstanding the whole picture. Why does bad news feel so much more convincing than good news? Especially when it comes to money. Pessimism sounds smart. Optimism sounds naive. But in finance, that mindset can be misleading and even dangerous. So, real-world example, when market crash, headlines explode. Recession is coming, market in panic. These stories spread very fast because fear grabs our attention. But when the market recovers quietly and grows for 10 years straight, that doesn't make headlines, even though it's more common and more powerful in the long run. And why we fall for pessimism? Because our brains are wired to respond to threat. So when someone say, the market might crash, we listen closely. But when someone say, it will be fine,
we brush it off. The reality, progress is slow and steady and often invisible. Setbacks are loud and sudden. The economy has grown massively over the last century, despite wars, recession, inflation, and crisis. If you always believe the pessimist, you will stay out of the market, miss opportunities, and live in fear. Being cautious is smart, but don't confuse constant pessimism with wisdom.
Human love stories. They help us make sense of the world, especially with the money. But sometimes we believe stories aren't true just because they feel good. People don't want cold data, they want explanation, even if those explanations are oversimplified, misleading, or totally wrong. When the stock market crashes, we say it is because inflation or it's political uncertainty. But sometimes market moves simply because investor panic or a computer algorithm triggered a chain reaction. Not everything has clear, neat a reason, but we crave one anyway. When we believe made up stories where we created confidence where there shouldn't be, we take a big risk, thinking we understand things we don't. Another example, someone might invest heavily in real estate after watching one person get rich, believing the story that property always goes up, but not always true, and ignores the complexity behind the success. So be careful of the stories that make you feel smart, in control, or ahead of the game. Always ask, it is really true or just emotionally satisfying?
After learning all this lesson about money, what should you actually do with them? This chapter brings it all together. There's no one-size-fits-all formula in personal finance, but there are timeless principles that work for most people most of the time. Here are some of them. The first is save money consistently, not for specific reason, but for flexibility and peace of mind. The second is plan on things going wrong, build a margin of safety into everything, investing, budgeting, even your career. Next, be reasonable, not just rational. Make decisions you can stick with even when markets or life get messy. Next, stay humble. You're never as smart as your best win and not as dumb as your worst loss. The next, define what enough means for you. Don't chase more just because others are. Avoid lifestyle creep. The more you earn, the more tempting it is to spend, but the rarely leads to happiness. Next is the expect surprises. The future will shock you. Be flexible, not rigid. The last is the invest long term. You don't need to beat the market, you just need to stay in it long enough. For reflection for our life is, the best financial decisions aren't flashy. They're often boring, patient, and built on good habits, not extreme strategies. So your personal finance plan doesn't have to impress anyone. It just has to work for you and help you live a life you enjoy.
After all the stories, lessons, and research, what does Morgan Housel himself actually do with his money? So, in this final chapter, the author doesn't preach perfection. Instead, he confesses that even he doesn't always follow what's rational. He follows what feels right for him. The first one, he saved a lot, not because he's aiming for a specific number, but because it gave him freedom and peace of mind. And then the second one, he invests simply. Most of his money is in low-cost index funds, not in high-risk strategies, because long-term patience beats trying to be a genius. And then the third one, he values independence. He makes financial choices based on what will give him the most control over his time and energy, not the highest returns. And for why even when taking on some debt would be mathematically smart, he chose peace of mind over extra risk. The 5 point, he live below his means. No, not because he has to, but because he wants to. Simple living gives him more flexibility and less stress. Okay, so finance is deeply personal. What works for you might not work for someone else, and that's okay. You don't have to chase the optimal plan. You just need the plan that makes sense to you and helps you sleep at night.
We've learned that money isn't just a number, it is behavior.
And that what works for one person may not work for another.
But if there's one thing that this book taught us, it's this.
The most important part of every plan is to plan on your plan not going according to plan.
Hi, I'm Renza.
I'm Gabriela.
And I'm Arini.
We're a student from IPMI International Business School.